Hi, I'm Monk and this is the Monk Way. Let's look at the best ways to invest just $1,000. This is the perfect amount of money to start investing in the stock market. We'll look at a few stocks that I will look into, and the best way to get the most out of this money. Don't miss a second because I'll include some real gems hidden inside this video, with tips and tricks you'll definitely need in the market. Subscribe and leave a like for more investing videos. I make these every day. And check out my stock market group below, where I show you guys every single buy or sell I make in the market. It's 75% off for a limited time. $1,000 is the perfect stepping stone into the stock market. With this money, you can get a lot of experience for when you have more money to invest with. If you're American, you're lucky because you can skip the trading fee of $7 per trade. Normally, that costs you $14 to trade once, or 1.4% of your $1,000. With a platform like Robinhood, this would be completely free. So Robinhood is a great place to start learning about the stock market and swing trading. Another platform I would recommend is M1 Finance. I have an affiliate link in the description below. The advantage of this platform is fractional shares, meaning you can own big companies for pennies. A company like Amazon might cost you $1,700, meaning you can't even buy one share on Robinhood. With M1 Finance, you can own Amazon and grow with them. If they double in price in 5 years, your money will double with them. M1 Finance is a perfect platform for the passive part of your portfolio, and it's completely free too. Check them out below the video. Otherwise, you can use a popular platform from your country. I'm Canadian, so I just use my bank, which does charge me $7 per trade, but it's not the end of the world. Understand that the average return for the passive investor is about 10% a year. You might not think 10% is a lot. After all, that's only $100 if you have $1,000 to start. I did the math, so here's something to blow your mind. With just $400 a month, at 10% returns a year, you'll be a millionaire in 40 years. Passive investing in index funds like the S&P 500 is the most safe and guaranteed way to make $1 million. This is why my first recommendation is to look into index funds. Personally, I have 50% of my money in index funds. I invest in the S&P 500 and the Nasdaq 100, VOO and QQQ if you're American, VFV and XQQ for Canadians. This is the passive part of my portfolio, and I expect around 10% a year. If I was starting with $1,000 today, I would put $500 in a passive fund on M1 Finance, and $500 in Robinhood to swing trade with. This lets me experience the markets while also experiencing slow growth over time. I would try to save a few $100s every month and add to that passive fund, and a little bit in the swing trade account. If I only had access to a platform that costs money to trade, I would only buy one stock or index fund to start with. Because if I bought two stocks, $500 each, I just lost 3% on each trade. That's not a great start. Now you know how to get started and the best places to trade. Let's see what kind of stocks we could look into with that money. I'll look at a few stocks I currently hold, just as a way to start your research. First, the index fund in VOO. This one is only $260 right now. You can buy 2 shares at $520 with half your money. This one charges a very small fee of 0.04% a year, almost nothing. For single stocks, I usually pick safer ones and 1 or 2 gambles. Let's start with a fun one in marijuana stocks. I'm not recommending you buy these companies, but look into them. Aurora Cannabis and Canopy Growth. They're the leaders in the field. Aurora is only $9.60 and Canopy Growth is only $45.90, meaning they're easy stocks to buy without spending all your money. Both stocks has risen over $1,000 in the past 5 years. This is due to legalization in Canada. Both stocks are very overpriced too, so they're the highest risk stocks I own. I own about $50,000 total of both stocks. That was your risky stock to look at, but you want to look at some safer stocks too. Let's look at 2 technology stocks I like right now. Facebook and Apple are very popular companies with huge market caps, meaning less volatile movements, and they both have good value when looking at their numbers. Facebook is only $161, you can afford 3 shares. And Apple is $186, about 3 shares as well. Apple is up 145% in the last 5 years, and they pay you 1.57% every year. Facebook is up 146% with no dividends. Both are on good dips of 20% or more. You want to buy good companies on good sales, but remember, buying a dip is not always the correct choice. The first few stocks you pick doesn't have to be perfect. That comes with experience and time. The first stock I picked was a TV company in Canada with a 9% dividend. I saw the 9% and I thought, what could go wrong? Luckily, I sold it before it dropped 40% or more, and got some nice dividends. For you guys, just buying a blue chip stock like Apple is a better start than most people. Your first portfolio might look something like this. 1 share of VOO for $260, 1 share of Apple for the stable blue chip company that pays dividends for $186, 20 shares of Aurora Cannabis as your gamble stock for $192, 3 shares of AT&T for that extremely high dividend of 6.6%, only $91, and $200 of a company you really like. Maybe Tesla for $267? It's all about diversification to keep you safe as a beginner. This portfolio has an index fund with 500 companies, 1 stable blue chip company, 1 high risk company, a bit of high dividends, a fairly stable company in AT&T, and something personal to you so you can find experience in picking stocks. A portfolio like this will show you the ins and outs of the markets. Don't worry about losing a few $100s, because that's the best way to learn. If you see your money crash 25% in the recent market downtrend, you just experience what investing feels like. The next time this happens, you can have less emotions about it and stay steady. If you can leave emotions out of the markets, you will be much more successful and not panic sell. If you invest with $1,000, you're likely new to the markets. I don't want to overwhelm you with too many numbers, so I'll just give you 2 very valuable tips. First, the price of a stock doesn't determine its value or how high it can go. Meaning a $9 stock like Aurora Cannabis or a $10 stock like Snapchat isn't a good deal just because they're around $10. A $1,000 stock like Google might be a better deal. This is because the price of a stock is only determined by how many shares the company wishes to have. If there are 1 million shares of Snapchat at $10, that's a total worth of $10 million. If Snapchat wishes to have 10 million shares tomorrow, they can reduce the price to $1 each. Or if they want only 1,000 shares, the stock price could be $1,000 each. So don't be fooled by a cheap stock price. It also doesn't determine if a stock can go up. $10 doubling to $20 might seem more likely than $1,000 doubling to $2,000, but that's not how stocks work. Each stock has the same chance of doubling. It's determined by how well the company is doing and how the public perceives the company. The other tip is a simple valuation number in the PE ratio. This is the most common ratio that comes up when people talk about stocks. If they say the PE ratio is low and looks good, that means the stock has high profits. If they say the stock has a high PE ratio and is overvalued, it means the company has low profits or sometimes no profits. Think about buying a stock like buying a whole company. You definitely want a company that generates more money over time. So what's a good amount of profit to expect? Since index funds gives us 10% a year, we can use that as a minimum. So a company worth $1 million should at least give us around $100,000 a year in profits. This would mean a PE ratio of 10. Think of it like this. A PE ratio of 10 means we're paying 10 times what they made in profits. So we're paying $1 million for the company and they made $100,000 in the past year. That's not a bad deal because it's about what the market gives us in returns. Right now the average PE ratio is 22, meaning most things are overpriced compared to the profits. So we want to look for a company with a lower PE ratio than 22. Apple is only 15 and Facebook is 21, both good values right now. A stock like Tesla has no PE ratio, so no profits, making it a higher risk. This is the only ratio you need to know right now. That's all you need to start investing in the markets. Subscribe and leave a like for more investing videos. I make these every day. And check out my stock market group below. It's 75% off for a limited time. Keep watching the About the Best Stocks, the Monk Way.